to put some numbers in perspective, what we have in the graphs are the GDP per capita in the US, in the Euro area, in Japan and China. And what we see is that we worry about a discrepancy between the Eurozone and the US, but it has started a long time ago. It's not recent. And it's been going on. And on the right-hand side, you get a global view of the percentage, the importance of each economy in the whole world. And although China per capita is still very much behind the US and Europe, you see that China now is a dominant economy, close to 20% of global GDP in purchasing power terms. And you also see that the Euro area has lost, in the last 35 years, has lost half of its importance, okay? It used to be close to 20% of the world, and now it's about 10%, okay? So that's what's going on globally. We worry about labor productivity in Europe. The fact that we grow less, it means that it's essentially the amount of productivity that's less, that's growing less relative to the US. Things are moving up, but not as fast. There is a big problem across the world, in Japan, in Europe, in the US, in China, which is the population is growing old, and the dependency ratio is increasing. That's important. We should always keep in our minds. And when it comes to growth, automatically we think of investment. And when we compare the US with Europe, and you look at the ratio of investment to GDP, it's the same in Europe and in the US. It's much less than in China. China is declining now. That we want it to happen. But on the right-hand side, what the graph shows is that we should worry about the quality of investment. And because now everything is digitalized and the world's becoming digital, and that's where demand is, that's where value added is, we see that the Euro area sort of has flattened out in terms of how much it invests. The US is moving much, much faster. Now, a lot of talk, and I guess in your mind, is about what about the governments? Can they really invest, or are they over-indebted? And I hear this sometimes in Europe. In reality is, if you look at Europe, the debt to GDP ratio is much less than the US. I would worry about the US, in fact, on the fiscal side. Japan is, of course, the worst, but it's trying to do a better job. And China, its debt has gone up. So the fiscal issue is less of a concern for me. It may be for specific countries in Europe, like France, Belgium, or Italy, but it's not a big problem. And the big problem in Europe, and I'll sort of stick to this transparency, is what the Draghi and the Letta reports mentioned. It's the supply side. Yeah. We need supply side economics in Europe because we are a fragmented union. We are not, and we have a problem of scale. And we are fragmented in the products and service markets. And now we're thinking about perhaps creating a 29th regime so to avoid and have similar regulations everywhere. We worry about DG competition. The DG Comp is thinking of companies large in a specific small country, and it's not thinking of Europe. So it has all these rules that prevent companies to grow big and tackle the whole European market. And we should be thinking of industrial policy European-wide, especially because the US is doing this, and China. Okay, so we have fragmented products and services market. Both Letta and Draghi made a big deal about it. We don't have a capital and banking union, and we want to create it. In fact, we need to boost savings. We need to boost domestic savings somehow. We have a fragmented labor market. People cannot move so easily and carry their pension with them so they can work everywhere. And of course, if you look at the union as a whole, we have external security problems. We realize them because of Trump. Can we address these issues? I have here a graph that says 2 years after the Draghi report, only 10% of the suggestions have been implemented. They were implemented a lot when it comes to critical raw materials, when it comes to transport and energy, but everywhere else we're behind. Of course, there's a political problem. We can always discuss about this. We need to have, perhaps the veto should be something that should become something of the past. And I have some graphs, especially that support what the Draghi report mentions. For example, this is a graph that shows that when it comes to banking union, we're becoming more and more closer together up until the great financial crisis. Like, when you look at the banks, close to about half of their assets were outside the home country. But after 2007, 2008, 2009, this has declined. Again, now only about a quarter of the asset side is outside. So when it comes to labor mobility and the fact that and the savings and labor and the savings and loan union, you see the big difference between. It's evident in how much the American worker and the American citizen saves for his pension. The total assets in pension funds in the U.S. are 160% of GDP, and in the euro area is only less than 30%. So we need to do something. We need to go away from the pay-as-you-go systems, create IRA accounts, keep the money in Europe. The money, we definitely have a lot of money. I'm going fast. We have a lot of money because we have general account surpluses, but the money goes to the U.S. And if you need to raise money, a company goes to the U.S. to raise money. And when it comes to defense, we're aware of the problem, we spend more on defense, and we need to do more.